Good evening, ladies and gentlemen. You know, we might be facing a situation in the up-and-coming it could happen really fast. It could happen in the next few days or weeks, or perhaps it might be a few months from now, but it seems like Deutsche Bank is going down. And we might be facing a situation that very similar to 2008. So I got a small article here I want to read, and it's a very short article, but the information in it is extremely potent. If you stop and you sit and you actually think about this information in this article, and I want to go over it, and it's vitally important, this information, even though it's only a short article, and I'm going to read it to you guys, and it's got everything to do with what might happen if Deutsche Bank goes under. It might cause this situation. So let's get started, and let's start the article, start the charts right here in the article right here. And now, here's what it is. Leading up into this article, what we've been talking about in this article is credit freeze. A credit market freeze, and this is what can actually happen, and they have to freeze the credit markets. You get a big bank like Deutsche Bank goes down, the systematic danger to the other banks, to stop the whole thing from actually melting down, they have to basically freeze everything. Stop, hold, freeze, Just like what the cops say, if the cops, they say, freeze, freeze. Well, that's the same way with this, freeze. Everything freezes. Now, in that period of time when everything's frozen, this is not just a credit market freeze. This could extend to all the banks, and not just interbank lending, but it could actually extend to you're not able to use your ATM machines. You're not able to use your debit cards. You're not able to use your credit cards during this period in time when they have to actually freeze everything. So, what'll happen? What's the effects of a credit freeze? Let's take a look here. It says the effects of the freeze on the banking system was catastrophic. Now, see, they're talking about the 2008 crisis right here. It said, first, it became known to the public that the banking system was in jeopardy. Well, I'm going to tell you, the banking system of the entire world can be in jeopardy if Deutsche Bank goes down, because it can cause a cascading effect of all these derivative products basically canceling each other out, and the collateral damage can spread through the financial system in a matter of hours, and they have to lock it all up. They basically have to lock it all up to stop it from completely melting down. It says the effects of the freeze on the banking system was catastrophic, talking about 2008. First, it became known to the public that the banking system was in jeopardy. The bankers did not trust each other, so how could they expect individuals to trust them with their money? As a result, there was old-fashioned runs on the bank, and some institutions were simply bankrupt. Well, this is what can happen. Apart from that, the banks were unable to find enough liquidity in their functioning. Unless they were able to generate more funds, the loan market capabilities were hindered, and usually they would just borrow the shortfall from the interbank market. However, of the interbank markets have simply frozen. So the whole thing freezes up, basically. It just locks up. Nobody can get any money. Nobody can borrow any money. Nobody knows exactly which institutions are in jeopardy at first. So what happens in a situation like this? Well, it's very simple. The central banks have to intervene. They have to. And this is what happened in 2008. It took central bank intervention to break this standoff credit freeze between the member banks. The European Central Bank and the Federal Reserve realized the gravity of the situation. Now, do you really believe, does anybody out there really believe, that if this happens again, the same sort of crisis, very similar, Say like Deutsche Bank going down suddenly, that the central banks are not going to intervene? It says, it took central bank intervention to break the standoff and the credit freeze between the member banks. The European Central Bank and the Federal Reserve realized the gravity of the situation. They also understood that unless action was immediately taken, more problems would arise. As a result, the Central Bank of Europe pumped billions of euros into the interbank market on its own. When banks were not willing to lend to one another, the central bank was willing to take on the risk of its member banks, seeing the situation stabilize in Europe. So they pumped money in, and the situation stabilized in Europe. The Federal Reserve also followed suit and pumped in billions of dollars into the U.S. interbank market. Once again, the Fed was willing to take the counterparty risk. As a result of this intervention, the credit freeze was eliminated. They've done it before. They can do the exact same thing all over again. Don't listen to people who say that the central banks do not have the tools they need this time to fight this. You will find, in truth, that when the situation hits and the credit freeze hits, that the central banks will have the tools to fight it with. They're going to pour money on it. It's as simple as that. It says the Fed and the European Central Bank had succeeded in temporarily kickstarting the market. Okay, so let's analyze that a little bit. The last time this happened in 2008, the Federal Reserve and the European Central Bank had succeeded in temporarily kickstarting the market. So, 2008 was not the magnitude of what's coming this time. And they temporarily succeeded in kickstarting the market, but we all know it took quantitative easing 1, it took quantitative easing 2, it took quantitative easing 3, it took Operation Twist. All of these pumping money into the system to keep the market going after they kickstarted it with all this money. So we can see a similar situation develop this time, where they're going to have to kickstart the market with more money than they did last time. It's going to take more this time, a lot more. And just that kickstart alone does not get things back up to normal again. This time they're going to require stimulus in bigger measures than quantitative easing 1, 2, 3, or Operation Twist. However, it says, they did not want to be making loans in the long run. In the long run, they wanted the banks to be lending out money to each other. Therefore, to induce this behavior and end the credit freeze, the banks and the ECB cut the repo rate by a few basis points. Okay? So, they were able to. They had more room back then. They had more leverage over this last crisis in 2008. They were able to lower interest rates down to 0. I think they had them up like 5% or something like that. And they had a good little spread there. They could drop interest rates. This time, they've only been able to manage to get the interest rate up a little bit over 2% this time. So they haven't got much room this time. So what are they going to do? It's very simple. It's very simple what they're going to do. Last time they had to go to zero interest rate policy. ZIRP. This time it's going to require something called NIRP. Negative interest rate policy. That's what it's going to require this time. So basically what we're looking at is a situation that would be very similar to 2008, except in a larger magnitude. And the central bank's responding to this same situation, but with a larger response. So this is basically what we're looking at. And instead of zero interest rates, we're looking at negative interest rates. Now, when you start to go into negative interest rates, where it costs all the banks, it costs all the people out there money to hold their money in the bank, then you got a problem. This is why they've been so desperate for the last little while, because they knew this is coming. They knew they could kick the can down the road quite a ways. Well, they're running out of road now, finally. But, you know, they've made this last for years. Since 2008. It's 11 years. They've been able to kick this can down the road a long ways, a lot further than most people thought they could. But they're reaching the end of the road now, and at this point in here, what we're talking about is a larger, more scope than 2008. And this time they're going to have to go into negative rates. And this is why they've been so desperate to get rid of cash, a cashless society. Because that way, when you go to the bank, you can't withdraw your money if there is no cash to withdraw. It's quite simple. And it's very effective. Walk up to the teller and say, oh, I want to take my money out of this bank. And she says, well, how are you going to do that, sir? We don't carry cash. It doesn't exist anymore. We can't give you cash. So you got to leave your money in the bank then, or purchase something with it. You know, this is what they want. This is their dream, you know. But it's not necessarily going to come true anytime soon, because people are so used to using cash. There's so many cash businesses out there, and there's so much cash in circulation. It's going to be something that's not that simple to actually do, but they wanted to try to get it done. It was their dream because they knew this was coming. And they don't want runs in the bank. But in fact, they didn't get rid of cash in time. Cash is still here. In fact, cash is still king. And what you're going to find happen is when this situation occurs this time and they take interest rates down into the negative interest rate policies, there's going to be runs on the banks. Going to be. And when people start to see the inflation that this is going to cause, this situation is going to cause to the world, from them having to try to re-stimulate the economy and reprop the markets back up and everything, the amount of stimulus that they're going to have to do, ultimately. But here's the thing. There's going to be a couple-week period there. I would say anywhere from 2 weeks to a month, the period could be, where they are actually trying to prop this system up, and they haven't propped it up yet, and everything's frozen. Your credit cards don't work. Your cash machine doesn't work. Nothing works. You can't take money out of the bank. That's why I've been telling people out there to put $5 bills away for yourself. A little stack of them. Right? Because you might have 2 weeks to a month when they're responding, especially if Deutsche Bank goes down in the next, I don't know, in the next couple months somewhere. It could go down tomorrow. Or it might be a few more months. But I see Deutsche Bank sliding off the cliff. Deutsche Bank goes off the cliff. Nothing's going to happen until Deutsche Bank goes off the cliff. And then it's going to be what they call a Lehman moment. It's going to be that moment that all of a sudden everything freezes up on everyone. It's going to be panic. It could be really panic. All across America, all across everywhere. If Deutsche Bank goes down, it could freeze everything up. Freeze the system up. And it might be several weeks before they get things back up and running, before the central banks actually are able to respond. You see, if you look at this carefully, you have to read this article carefully. In this credit freeze, it says, as a result of the credit freeze, the Central Bank of Europe pumped billions of euros into the interbank market on its own. While banks were not willing to lend to one another, the central bank was willing to take on the risk of its member banks. Seeing the situation stabilize in Europe, the Federal Reserve also followed suit, pumping billions of dollars into the economy. They'll do the same thing this time, except bigger. But it takes a little while. They have to go into meetings and everything, and then they have to discuss what they're going to do, and then they have to decide and then they wait a few days, a few days goes by while they have another meeting, and then they discuss policy and everything, and then they have to come out and announce their policy, and then they say it'll be a couple days before it comes into effect, and then it's always a waiting game. And so during that waiting game, you might be looking at anywhere from between 2 weeks and a month before they finally actually start injecting that money in, and credit starts to actually flow again. Then you go back to the bank, and you're able to use your cards again. And everybody breathes a collective sigh of relief once the system starts running again, you know. During that period in time, that's when you need your $5. Because $5 is perfect. Think about it, really, you know. If we get a crisis like that, you're not going to want to go hauling any big bills out of your pocket. And first off, a lot of people aren't going to be able to make change. It's quite simple as that, you know. Would you, if you go into a store and they're not able to make change for you, and you want to buy a bag of flour, say, right? And the bag of flour is $5. And you got to 20 and they can't make change, but you desperately need that $5. Would you rather give them a $5 or would you rather give them the 20 and have them keep the change? You know what I mean? Worse yet, imagine these people that only have a gold coin or something like that, you know? What, are they going to pay $1,500 for a bag of flour if the guy can't make change? I mean, you got to have a little bit of cash will be king. And first off, they don't take gold anyway. But, you know, I mean, if a guy was really desperate, if his wife at home yelled at him, you go out and get me that flour, I got to make my pancakes or I got to make my cake this afternoon, and if you don't come back with that flour, I'm going to wring your neck, she says. Well, he might go out there and he might have to give that little piece of gold, you know, for flour. Somebody might be willing to take it anyway. So anyway, I digress. So this is the situation we might be facing with Deutsche Bank imminently. It might actually be smart if you haven't done any preparation up till this point to do a little bit of preparation for yourself, just in case we get this credit freeze. It could happen actually very suddenly if Deutsche Bank goes down, because I think they have like $44 trillion worth of derivatives. Now, a lot of those derivatives, they cancel each other out, but once that spreads out of the system, once it's clear that Deutsche Bank has collapsed and those derivatives are hanging there by a thread, then what it does is it goes through the financial system and it clarifies where the losses are going to be and what banks are going to take the losses for those derivatives. And that's when they have to freeze the credit, because not so much of Deutsche Bank, not so much because of Deutsche Bank, but because of all the collateral damage that it causes through the system has to be straightened out. They have to fix it. They have to repair it. And they can only repair it with money. Listen, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.